Present worth analysis is a fundamental concept in finance and economics. It helps us make informed decisions about investments and projects. The basic idea is to compare the value of money today to the value of money in the future. This comparison allows for rational decision-making when considering different investment opportunities. At its core, present worth analysis recognizes that money has a time value. A dollar received today is worth more than a dollar received in the future. This difference in value is due to the potential for earning interest or returns on investments. By discounting future cash flows back to their present value, we can level the playing field and compare investments on an equal footing. Present worth analysis finds applications in various financial decisions, from evaluating capital projects to assessing the profitability of investments. It provides a structured framework for comparing alternatives and selecting the most financially viable option. By quantifying the value of future cash flows in today's terms, we can make informed decisions that maximize our financial well-being. In essence, present worth analysis is a powerful tool that allows us to make sound financial decisions by considering the time value of money. By converting future cash flows into their present-day equivalents, we can compare different investment opportunities objectively and select the most financially advantageous option. Whether evaluating capital projects, assessing investment opportunities, or making personal financial decisions, present worth analysis provides a solid foundation for rational decision-making. In financial analysis, we often use the end-of-year convention to simplify calculations. This convention assumes that all cash flows occur at the end of each year. While this may not reflect reality perfectly, it provides a reasonable approximation for decision-making purposes. By assuming end-of-year cash flows, we can simplify the discounting process and focus on the overall financial picture. From an economic standpoint, it's essential to consider the role of borrowed money in present worth analysis. When we borrow money, we incur interest expenses, which represent the cost of using those funds. In present worth calculations, we must account for these interest expenses to reflect the true cost of an investment. By discounting future cash flows at the appropriate interest rate, we ensure that the analysis accurately reflects the cost of capital. The economic viewpoint also emphasizes the importance of considering the opportunity cost of capital. When we invest in one project, we forgo the opportunity to invest in other potential projects. The opportunity cost of capital represents the potential returns we could have earned if we had invested in the next best alternative. In present worth analysis, we implicitly consider the opportunity cost of capital by using a discount rate that reflects the returns we could achieve from other investments with similar risk profiles. Understanding the end-of-year convention and embracing the economic viewpoint are crucial aspects of effective present worth analysis. These concepts provide a framework for simplifying calculations and ensuring that our analysis reflects the true cost of capital and the opportunity cost of our investment decisions. Inflation and deflation can significantly impact present worth outcomes. Inflation erodes the purchasing power of money over time, meaning that a dollar received in the future will be worth less than a dollar today. Conversely, deflation increases the purchasing power of money, so a dollar received in the future will be worth more than a dollar today. To account for these effects, we adjust the discount rate in our present worth calculations. We use a higher discount rate during inflationary periods to reflect the declining value of money and a lower discount rate during deflationary periods. Taxes represent another crucial factor in present worth analysis. When evaluating investment opportunities, we must consider the tax implications of our decisions. Taxes can significantly impact the profitability of an investment, either positively or negatively. For instance, tax deductions on depreciation expenses can enhance the after-tax cash flows from an investment, making it more attractive. Conversely, taxes on capital gains can reduce the after-tax returns from an investment. Incorporating tax implications into present worth analysis involves adjusting the cash flows to reflect the tax impact. We deduct taxes from taxable income and add back tax savings to arrive at the after-tax cash flows. By considering the after-tax cash flows, we can make more informed decisions that maximize our financial returns. It's important to note that tax laws and regulations can be complex and vary significantly across jurisdictions. Therefore, seeking guidance from tax professionals is crucial to ensure accurate and compliant tax calculations in present worth analysis. Present worth analysis is particularly useful when comparing multiple investment alternatives. By calculating the present worth of each alternative, we can rank them based on their financial attractiveness. The alternative with the highest present worth is generally the most financially viable option. For example, let's say a company is considering two investment projects, Project A and Project B. Project A requires an initial investment of $1 million and is projected to generate annual cash flows of $300,000 for 5 years. Project B requires an initial investment of $1.5 million and is projected to generate annual cash flows of $400,000 for 5 years. To determine which project is more financially attractive, we would calculate the present worth of each project using an appropriate discount rate. The project with the higher present worth would be the preferred option, assuming all other factors are equal. This comparison allows for a clear and objective evaluation of the financial viability of each alternative, facilitating informed decision-making. In conclusion, present worth analysis is a crucial tool for evaluating investment opportunities and making sound financial decisions. By considering the time value of money, inflation, taxes, and other relevant factors, we can use present worth analysis to compare alternatives and select the most financially advantageous option. Whether evaluating capital projects, assessing investment opportunities, or making personal financial decisions, present worth analysis provides a solid foundation for rational decision-making.